Hi, everyone. This is May Doldolau, and I'm here with you today on Creative Abundance Now on YouTube and on my blog, yesfinanciallyfree.com, and on Instagram. So this is my name, May Doldolau, and it is a pleasure and honor to be serving you today by doing this live reading of Chapter 5 of The Intelligent Investor by Benjamin Graham, which Warren Buffett states by far the best book on investing ever written, by the way. So we're going to read Chapter 5. Before I begin, my blog is yesfinanciallyfree.com. I highly recommend, if you haven't gone there already, to go there, put in your first name and your email address, and get on the email list, because I just emailed my list the links to this broadcast. I told them what I would be talking about, and I do that every time. And right now, every weekday at 8:30 a.m. Hawaii time, which is right now, I do a reading out of this book. And I'm doing it because I want to become a better investor. And now the stock market is down. So what's the perfect time to invest in stocks now, right? But I want to do it intelligently. Chapter 5 of The Intelligent Investor by Benjamin Graham. The Defensive Investor and Common Stocks. So today we're going to learn about something that most people do, which is invest in common stocks defensively, which means like they have an index fund or just, they're not looking to beat the market. They're just investing for the long haul, right? So we're going to talk about something most people who invest at all do. So it's going to be cool to hear what Benjamin Graham says. But before I begin that, I just want to mention, like I said, my name is May. I live in Honolulu, Hawaii. It's a beautiful space. It's so sunny today and the sunlight's coming in, and I really appreciate my life and that I live such a blessed life here. Right now during this pandemic, we're all have this stay-at-home order and we can only go out to exercise and stuff. But when I go out, I will go out in beautiful Hawaii. I can go surfing. I can go boogie boarding with my son, or body surfing. I can go running, jogging, biking. It's a blessing to live in such a beautiful environment, which is warm. The weather is nice. It's easy to be healthy here. So I feel very blessed about that. Now, I didn't always live here. I'm not originally from here. I moved here back in 2003. So I've been here 17 years, a long time. What, 2003? Yeah, wow, almost 17 years. Amazing, right? So I feel very blessed to live here and call this place home. When I first started my journey on finances, and when I started, right before I even started yesfinanciallyfree.com, I was really bad with money. So I wasn't even thinking of blogging about money. I was trying to pay my bills and not be behind on my payments. I had over 8 different lines of credit cards, owed over $41,000 in consumer debt. It was overwhelming for me at the time. I had a lot of days where I was crying and I was sad, and I didn't know how I was going to get out of it. I had a job. I worked at a bank. I was a banking assistant, but I only made like $34,000 a year, right? And that's before taxes are taken out. And I owed $41,000. It was something that was a very overwhelming time. But long story short, by 2016, all debt paid off. I'd improved our family's net worth by $500,000. I quit my job to become a full-time mother, part-time finance freedom coach, where I coach clients also how to make passive income. When I quit my job, we were making almost $500 a month, every month, in passive income. And I quit my job so that I could be with my son more, and also to develop our business online, as well as coach others on how to become financially free as quickly as possible. In 2017, we went on 1 month of vacation: Niagara Falls, Los Angeles, Toronto. We went to Mexico on a cruise, a 1-week cruise. I'd never done that. It was a dream. Like, it was one of my dream board visions to go on a cruise, and we did that. We bought our first condo in Waikiki in 2018. Bought our second condo, an investment property in Waikiki. 2018, we sold one of our condos to one of our mastermind members as a profitable Airbnb business, and we bought this condo, which is a larger, bigger condo in Waikiki. And it's been a really wonderful, blessed journey. And I thank God and I thank you for watching and being a part of it. And I want to bring value to you as well as myself. My philosophy is win-win. If you can win and I can win at the same time, then I can go on doing this forever. Yeah, because win-wins work for everyone. So at yesfinanciallyfree.com, I have information on how to invest, how not to invest, how to manage your finances, how to change your mindset, how to become financially free through your mind, but also through real actions like paying yourself first, tracking your net worth. What is net worth? How do you do it? What is an income statement, balance sheet, things like that. Other books that I've read, insights, things that I've learned from seminars where I paid thousands of dollars to go. I share with you years of blogs at yesfinanciallyfree.com. So go there, check it out, get on the email list, put your name on the right side and your email address. Get on my email list. I'm real friendly. I send really awesome emails. And you can always unsubscribe anytime. But you get a free ebook when you sign up, Working Parents Guide to Financial Freedom. So if you're on Instagram, just go to the link in the profile. If you're on YouTube, I will put the link on this after I finish this video. All right. But thank you so much for being on the live. I really, really do appreciate you. And I'm excited to read today's chapter. I think it'll be fun. Final thing. That's my son, Jordan. Want to say hi, Jordan? Finally, he's 6 years old now. Final word. And just so you understand, I have a products page on this blog, yesfinanciallyfree.com. I highly recommend you go there, find a product that resonates with you. If you love the free ebook, there's a $7 7-day passive income, pay yourself passive income challenge. There's a 1-year finance freedom makeover for $97. There's the Finance Freedom Training Live program with live coaching, and that's $197 a month. And then there's the Mastermind, the full all access, most highly recommended program where you get group training every week, small group lesson, but not just a lesson, the Mastermind, where we work together to make each other financially free as quickly as possible, everyone together. All right, everyone together. And that we meet once a week for a year, 40-minute sessions that are recorded so you can replay them whenever you want for the rest of your life. And we also have weekly Q&A session, optional to jump on with me live every week on a Zoom, of course. And also, we also have monthly coaching, one-on-one to get your balance sheet income statement done every month, create passive income, strategize on how to increase it. We track your numbers. We track your passive income. It's like a game that makes you financially free, and that is Finance Freedom Mastermind. Those products are all at yesfinanciallyfree.com/products. So go check it out. All right, so today, chapter 5, I'm going to begin reading. So if you love this, by the way, subscribe to the channel on YouTube, join the email list, share this with your friends and followers, and we will begin. I believe in knowledge and expanding ourselves through the accumulation of knowledge, being good citizens, having right mindset. I meditated right before we started. So let's begin. Chapter 5, the defensive investor and common stocks. Oh, before I start, hold on a second. Your breakfast is right there, Jordan. If you get your water bottle, you can go ahead and eat. When I'm done, I'll be right with you. Okay? All right, here we go. The Defensive Investor and Common Stocks, Chapter 5 of The Intelligent Investor of Benjamin Graham. Investment merits of common stocks. In our edition, 1949, we found it necessary at this point to insert a long expedition of the case for including a substantial common stock component in all investment portfolios. Common stocks, I got a pirate hat now. Oh, common stocks were generally viewed as highly speculative and therefore unsafe. They had declined fairly substantially from the high levels of 1946, but instead of attracting investors to them because of their reasonable prices, this fall had had the opposite effect of undermining confidence in equity securities. We have commented on the converse situation that has developed in the ensuing 20 years, whereby the big advance in stock prices made them appear safe and profitable investments at record high levels, which might actually carry with them a considerable degree of risk. The argument we made for common stocks in 1949 turned on two main points. The first was that they had offered a considerable degree of protection against the erosion of the investor's dollar caused by inflation, whereas bonds offered no protection at all. The second advantage of common stocks lay in their higher average return to investor over the years. This was produced both by an average dividend income exceeding the yield on good bonds and by an underlying tendency for market value to increase over the years in consequence of the reinvestment of undistributed profits. While these two advantages have been of major importance and have given common stocks a far better record than bonds over the long-term past, we've consistently warned that these benefits could be lost by the stock buyer if he pays too high a price for his shares. We have consistently warned, we just said that. This was clearly the case in 1929, and it took 25 years for the market to climb back to the ledge from which it had abysmally fallen in 1929 to 1932. Since 1957, common stocks have once again, through their high prices, lost their traditional advantage in dividend yield over bond interest rates. It remains to be seen whether the inflation factor and the economic growth factor will make up in the future for this significantly adverse development. It should be evident to the reader that we have no enthusiasm for common stocks in general at the 900 Dow Jones Industrial Average level in late 1971. For reasons already given, we feel that the defensive investor cannot afford to be without an appreciable proportion of common stocks in his portfolio, even if he must regard them as the lesser of two evils, the greater being the risk attached to an all-bond holding. Rules for the common stock component. The selection of common stocks for the portfolio of the defensive investor should be relatively simple matter. Here we would suggest 4 rules to be followed. 1. There should be adequate but not excessive diversification. And this might mean a minimum of 10 different issues and a maximum of about 30. We don't really do that today, but it's an interesting rule. Number 2, each company selected should be large, prominent, and conservatively financed. Indefinite as these adjectives must be, their general sense is clear. Observations on this point are added at the end of the chapter. Each company should have a long record of continuous dividend payments. All the issues in the Dow Jones Industrial Average met this dividend requirement in 1971. To be specific on this point, we would suggest the requirement of continuous dividend payments beginning at least in 1950. The investor should impose some limit on the price he will pay for an issue in relation to its average earnings over, say, the past 7 years. We suggest that this limit be set at 25 times such average earnings and not more than 20 times those of the last 12-month period. But such a restriction would eliminate nearly all the strongest and most popular companies from the portfolio. In particular, it would ban virtually the entire category of growth stocks, which have for some years past been the favorites of both speculators and institutional investors. We must give our reasons for proposing so drastic an exclusion. Growth stocks and the defensive investor. The term growth stock is applied to one which has increased its per-share earnings in the past at well above the rate for common stocks, generally, and is expected to continue to do so in the future. Some authorities would say that a true growth stock should be expected at least to double its per-share earnings in 10 years, to increase them at a compounded annual rate of over 7.1%. Obviously, stocks of this kind are attractive to buy and to own, provided the price paid is not excessive. The problem lies there, of course, since growth stocks have long sold at high prices in relation to current earnings and at much higher multiples of their average profits over a past period. This has introduced a speculative element of considerable weight in the growth stock picture and has made successful operations in this field far from simple matter. The leading growth issue has long been International Business Machines, IBM, and it has brought phenomenal rewards to those who bought it years ago and held on to it tenaciously. But we have already pointed out that this best of common stocks actually lost 50% of its market value in a 6-month decline during 1961 to 1962, and nearly the same percentage in 1969 to 1970. other growth stocks have been even more vulnerable to adverse developments. In some cases, not only has the price fallen back, but the earnings as well, thus causing a double discomfiture to those who own them. A good second example for our purpose is Texas Instruments, which in 6 years rose from 5 to 256 without paying a dividend, while its earnings increased from 40 cents to $3.91 per share. Note that the price advanced 5 times as fast as the profits. This is characteristic of popular common stocks. But 2 years later, the earnings had dropped off by nearly 50% and the price by 4/5 to 49. The reader will understand that from these instances why we regard growth stocks as a whole as too uncertain and risky a vehicle for the defensive investor. Of course, wonders can be accomplished with the right individual selections bought at the right levels and later sold after a huge rise and before the probable decline. But the average investor can no more expect to accomplish this than to find money growing on trees. In contrast, we think that the group of large companies that are relatively unpopular, therefore obtainable at reasonable earnings multipliers, offers a sound, if unspectacular area of choice by the general public. We shall illustrate this idea in our chapter on portfolio selection. Portfolio changes. It is now standard practice to submit all security lists for periodic inspection in order to see whether their quality can be improved. This, of course, is a major part of the service provided for clients by investment counselors. Nearly all brokerage houses are ready to make corresponding suggestions without special fee in return for the commission business involved. Some brokerage houses maintain investment services on a fee basis. Presumably, our defensive investor should obtain, at least once a year, the same kind of advice regarding changes in his portfolio as he sought when his funds were first committed. Since he will have little expertness of his own on which to rely, it is essential that he entrust himself only to firms of the highest reputation. Otherwise, hi, Karan. How you doing? Nice to see you on. My friend Karan. We create wonderful retreats for women together. Since he will have little expertness of his own on which to rely, it is essential that he entrust himself only to firms of the highest reputation. Otherwise, he may easily fall into incompetent or unscrupulous hands. It is important in any case that at every such consultation he make clear to his advisor that he wishes to adhere closely to the 4 rules of common stock selection given early in this chapter. Incidentally, if his list has been competently selected in the first instance, there should be no need for frequent or numerous changes. Dollar cost averaging. The New York Stock Exchange has put considerable effort into popularizing its monthly purchase plan, under which an investor devotes the same dollar amount each month to buying one or more common stocks. This is an application of a special type of formula investment known as dollar cost averaging. During the predominantly rising market experience since 1949, the results from such a procedure were certainly to be highly satisfactory, especially since they prevented the practitioner from concentrating his buying at the wrong times. In Lucille Tomlinson's comprehensive study of formula investment plans, the author presented a calculation of the results of dollar cost averaging in the group of stocks making up the Dow Jones Industrial Index. Tests were made covering 23 10-year purchase periods, the first ending in 1929, the last in 1952. Every test showed a profit either at the close of the purchase period or within 5 years thereafter. The average indicated profit at the end of the 23 buying periods was 21.5%, exclusive of dividends received. Needless to say, in some instances, there was a substantial temporary depreciation at market value. Ms. Tomlinson ended her discussion of this ultra-simple investment formula with the striking sentence, "No one has yet discovered any other formula for investing which can be used with so much confidence of ultimate success, regardless of what may happen to security prices, as dollar cost averaging." It may be objected that dollar cost averaging, while sound in principle, is rather unrealistic in practice because few people are so situated that they can have available for common stock investment the same amount of money every year for, say, 20 years. It seems to me that this apparent objection has lost much of its force in recent years. Common stocks are becoming generally accepted as a necessary component of a sound savings investment program. Thus, Systematic and uniform purchases of common stocks may present no more psychological and financial difficulties than similar continuous programs for United States savings bonds and for life insurance, to which they should be complementary. The monthly amount may be small, but the results after 20 or more years can be impressive and important to the saver. The investor's personal situation. At the beginning of this chapter, we referred briefly to the position of the individual portfolio owner. Let us return to this matter. In the light of our subsequent discussion of general policy, to what extent should the type of security selected by the investor vary with his circumstances? As concrete examples representing widely different conditions, we shall take. Number 1, a widow left $200,000 with which to support herself and her children. 2, a successful doctor in mid-career with savings of $100,000 and yearly accretions of $10,000, and a young man earning $200 per week, saving $1,000 a year. For the widow, the problem of living on her income is a very difficult one. On the other hand, the need for conservation in her investments is paramount. A division of her fund about equally between United States bonds and first-grade common stocks is a compromise between these objectives and corresponds to our general prescription for the defensive investor. The stock component may be placed as high as 75% if the investor is psychologically prepared for this decision, and if she can be almost certain she is not buying at too high a level. Assuredly, this is not the case in early 1972. Hi, 808, John Lano, welcome. We do not preclude the possibility that the widow may qualify as an enterprising investor, in which case her objectives and methods will be quite different. The one thing the widow must not do is to take speculative chances in order to make some extra income. By this, we mean trying for profits or high income without the necessary equipment to warrant full confidence in overall success. It would be far better for her to draw $2,000 per year out of her principal in order to make both ends meet than to risk half of it in poorly grounded and therefore speculative ventures. The prosperous doctor has none of the widow's pressures and compulsions, yet we believe that his choices are pretty much the same. Is he willing to take a serious interest in the business of investment? If he lacks the impulse or the flair, he will do best to accept the easy role of the defensive investor. The division of his portfolio should then be no different from that of the typical widow, and there would be the same area of personal choice in fixing the size of the stock component. The annual savings should be invested in about the same proportions as the total fund. The average doctor may be more likely than the average widow to elect to become an enterprising investor, and he is perhaps more likely to succeed in the undertaking. He has one important handicap, however, the fact that he has less time available to give to his investment education and to the administration of his funds. In fact, medical men have been notoriously unsuccessful in their security dealings. The reason for this is that they usually have an ample confidence in their own intelligence and strong desire to make good return on their money, without the realization that to do so successfully requires both considerable attention to the matter and something of a professional approach to security values. Finally, the young man who saves $1,000 a year and expects to do better gradually finds himself with the same choices, though for still different reasons. Some of his savings should go automatically into Series E bonds. The balance is so modest that it seems hardly worthwhile for him to undergo a tough educational and temperamental discipline in order to qualify as an aggressive investor. Thus, a simple resort to our standard program for the defensive investor would at once the easiest and most logical policy. Hi, Pirate Jordan. Let us not ignore human nature at this point. Finance has a fascination for many bright young people with limited means. They would like to be both intelligent and enterprising in the placement of their savings, even though investment income is much less important to them than their salaries. The attitude is all to the good. There is a great advantage for the young capitalist to begin his financial education and experience early. If he is going to operate as an aggressive investor, he is certain to make some mistakes and to take some less losses. Youth can stand these disappointments and profit by them. We urge the beginner in security buying not to waste his efforts and his money in trying to beat the market. Let him study security values and initially test out his judgment on price versus value with the smallest possible sums. Thus, we return to the statement made at the outset that the kind of securities to be purchased and the rate of return to be sought depend not on the investor's financial resources, but on his financial equipment in terms of knowledge, experience, and temperament. Note on the concept of risk. It is conventional to speak of good bonds as less risky than good preferred stocks, and of the latter as less risky than good common stocks. From this was derived the popular prejudice against common stocks because they are not safe, which was demonstrated in the Federal Reserve Board's survey of 1948. We should like to point out the words risk and safety are applied to securities in two different senses, and with a resultant confusion in thought. A bond is clearly proved unsafe when it defaults its interest or principal payments. Similarly, if a preferred stock or even a common stock is bought with the expectation that a given rate of dividend will be continued, then a reduction or passing of the dividend means that it has proved unsafe. It is also true that an investment contains a risk if there is a fair possibility that the holder may have to sell at a time when the price is well below cost. Nevertheless, the idea of risk is often extended to apply to a possible decline in the price of a security, even though the decline may be of a cyclical and temporary nature, and even though the holder is unlikely to be forced to sell at such times. These chances are present in all securities, other than United States savings bonds, and to a greater extent in the general run of common stocks than in senior issues as a class. But we believe that what is here involved is not a true risk in the useful sense of the term. The man who holds a mortgage on a building might have to take a substantial loss if he were forced to sell at an unfavorable time. That element is not taken into account in judging the safety or risk of ordinary real estate mortgages, the only criterion being the certainty of punctual payments. In the same way, the risk attached to an ordinary commercial business is measured by the chance of its losing money, not by what would happen if the owner were forced to sell. In Chapter 8, we shall set forth our conviction that the bona fide investor does not lose money merely because the market price of his holdings declines. Hence, the fact that a decline may occur does not mean that he is running a true risk of loss. If a group of well-selected common stock investments show a satisfactory overall return as measured through a fair number of years, then this group of investment has proved to be safe. During that period, its market value is bound to fluctuate. As likely as not, it will sell for a while under the buyer's cost. If that fact makes the investment risky, it would then have to be called both risky and safe at the same time. This confusion may be avoided if we apply the concept of risk solely to a loss of value which either is realized through actual sale or is caused by a significant deterioration in the company's position, or more frequently perhaps, is a result of the payment of an excessive price in relation to the intrinsic value of the security. Many common stocks do involve risks of such deterioration, but it is our thesis that a properly executed group investment in common stocks does not carry any substantial risk of this sort, and that therefore it should not be termed risky merely because of the element of price fluctuation. But such risk is present if there is danger that the price may prove to have been clearly too high by intrinsic value standards, even if any subsequent severe market decline may be recouped many years later. Note on the category of large, prominent, and conservatively financed corporations. The quoted phrase in our caption was used earlier in the chapter to describe the kind of common stocks to which defensive investors should limit their purchases, provided also that they had paid continuous dividends for a considerable number of years. A criterion based on adjectives is always ambiguous. Where is the dividing line for size, for prominence, and for conservatism of financial structure? On the last point, we can suggest a specific standard that, though arbitrary, is in line with accepted thinking. An industrial company's finances are not conservative unless the common stock at book value represents at least half of the total capitalization, including all bank debt. For a railroad or public utility, the figure should be at least 30%. The words large and prominent carry the notion of substantial size combined with a leading position in the industry. Such companies are often referred to as primary. All other common stocks are then called secondary, except that growth stocks are ordinarily placed in a separate class by those who buy them as such. To supply an element of concreteness here, let us suggest that to be large in present-day terms, a company should have $50 million in assets or do $50 million of business. Again, to be prominent, a company should rank among the first quarter or first third in size within its industrial group. It would be foolish, however, to insist upon such arbitrary criteria. They are offered merely as guides to those who may ask for guidance, but any rule which the investor may set for himself and which does not no violence to the common sense meanings of large and prominent should be acceptable. By the very nature of the case, there must be a large group of companies that some will and others will not include among those suitable for defensive investment. There is no harm in such diversity of opinion and action. In fact, it has a salutary means good effect upon stock market conditions because it permits a gradual differentiation or transition between the categories of primary and secondary stock issues. And then number 3, he says, he has a footnote here. When he said an industrial company's finances are not conservative unless the common stock at book value represents at least half of the total capitalization, including all bank debt. It says, number 3, all 30 companies in the Dow Jones Industrial Average met this standard in 1971. Okay, so we're done with chapter 5. Thank you so much for being on this live. That was chapter 5 of The Intelligent Investor by Benjamin Graham, The Defensive Investor and Common Stocks. And my name again is May Duldalau. Blog is yesfinanciallyfree.com. Go there, put in your first name, email address on the right side, and get on the email list. Thank you so much for being on the live. I appreciate you. Have a great Thursday. And if you're watching the replay, please share this with your friends and followers. Let's educate ourselves together on the greatest book on investing, as stated by Warren Buffett. Okay, namaste, aloha. Thank you for being on the live. Bye, guys.